Hello everyone, this is Tom Fox. I'm the Compliance Evangelist, and I'd like to welcome you to a special 5-part Compliance Into the Weeds podcast series. This week, Matt Kelly and I are going to focus on the new FASB revenue recognition standards. Each day, we will take a different topic and in a short 10-minute podcast, give you the highlights of what we think are important. We have coupled this podcast series with an ebook we've released, which will be in the show notes, that you can take a look at some of the key components of this new revenue recognition standard. On day one, we'll introduce the new revenue recognition standard and its implementation timeline. On day two, we will consider how you should determine transaction price going forward. On day three, we're going to take a look at the specific software sector and how this new revenue recognition standard can shake up that industry, that sector. On day four, we'll take a look at disclosures, ICFR audits, and what the PCAOB has published on this new revenue recognition standard. And Friday, we'll wrap it up, and I will tie it into what I think is the importance for the compliance practitioner. I hope you will enjoy this new podcast format series that Matt and I put together. We've certainly enjoyed researching it and recording it for you. Compliance Into the Weeds is a part of the Compliance Podcast Network. Hello, everyone. Tom Fox and Matt Kelly back for the concluding podcast in our 5-podcast series on the new revenue recognition standards. Today, we're going to try to wrap it up with some thoughts on what it all means. So, Matt, you want to lead us off with some of your initial conclusions?
What does it all mean? On a practical basis, this new standard means a lot of work for probably the next 12 months at least, and particularly the next 6 months or so from the end of this year until about May or June of 2018, as most large companies publish their first annual reports under the new revenue recognition rule. It is difficult to say how many companies will go through all of this to find that actually their numbers won't change to any material amount. I wouldn't be surprised if for a majority of companies, the numbers don't change. However, for a lot of companies, you can't really quantify it, but I think for most of them, a lot of the internal mechanisms are going to get a lot more scrutiny. A lot of the internal processes to figure out how are we justifying what we're reporting to investors and auditors, how are we coming up with the numbers we're coming up with? That's going to change for a lot of companies. That's not a bad thing. Much like Sarbanes-Oxley compliance, I think this new revenue standard is going to be a lot like going to the gym. Over the long course of time, going to the gym will make you feel great, and it's awesome for your health. First time you go to the gym, you do not feel awesome. You feel like you've been hit by a truck. That was true with SOX compliance. I think it will be true here. But over time, I think this is ultimately going to be good for the business community as a whole. And sure, audit firms are going to probably be giving you a somewhat more challenging experience for the next year or two. Some portion of companies will change their numbers to a material extent. Again, you're not losing or gaining money. It's just when are you recognizing it and how are you recognizing it? That's what's going to change. And if you fall into that category, you need to think through what are the consequences of that. Like we said a couple of days ago, for the software sector in particular, this could affect how they're valued. And software companies live to be acquired or merge with some other company. And if this changes the valuation principles we've been using, that's a big, big shift for a lot of companies. So I remain uncertain how many of the senior executives outside the finance sector, outside of the financial department, how do they really understand what's going on? But I think in a lot of large firms, people are now aware of this. I think they're doing their homework. We'll get through it, but that's some of what it all means right now.
So I don't really have a list of what I think it means, Matt. What I have is a list of perhaps even more questions. And we've explored many of these, but I think these are questions that are going to need each company and each company's internal and external auditors to have some lengthy conversations about, because I think the SEC has made clear in both their public statements and early comment letters that companies must inform the SEC about accounting policies that are changing and how these changes are going to be managed going forward. It's a long-winded way of me saying I see this as really a compliance issue. So some of the questions that came up for me, really in day one, I was wondering kind of who is the customer? Do we really know who that customer is? And it may seem straightforward, but if you've got third-party sales agents, if you've got distributors, if you've got sub-agents within that list, if you have, excuse me, in country local agents, are they going to be part of your customer list? The also the area of what is you talked in an earlier episode about fraud risk. If I could claim that corruption is a part of a fraud risk, what is the payments, both cash and non-cash? Is that consideration for the contract? When is that consideration transfer? What will be the discounts? We've seen numerous bribery schemes where discounts, rebates, or other mechanisms were used, and how does that tie into this new standard? Operationalization of a compliance program is obviously something that's talked about quite a bit, but Matt, actually I see almost the same conversation around this new revenue recognition standard for the following reason. I see business persons, lawyers, the legal department, and corporate functions that typically are not making decisions on revenue and revenue recognition to be at least a part of the process. This is driving down questions that auditors have to ask, both internal and external auditors, down literally to salesmen on the front lines about what are the payment terms, are the payment terms followed, when are you delivering, and who is your customer at the end of the day. Those are things that I don't think have been articulated as traditionally in making these kinds of assumptions that auditors make. So you talked about transparency and the SEC desiring greater transparency. I would really see it as moving the conversation to business units that may not have been a part of that conversation before. And if transparency is moving that so more people have to be a part of it, I would certainly second the notion of transparency. But I see this as almost operationalization of revenue recognition within an organization.
Yeah, I think that's pretty much fair to say. Two thoughts that I do have, and before it slips my head, I did want to say one thing about the Securities and Exchange Commission has already made clear that it will be watching this first year of financial statements under the new standard closely, but it is not going to fry anybody over an open flame for confusion or getting it wrong. If you are cooking the books, even under the new standard, yes, they will still come after you. However, if you are trying to prepare the books in the correct way and you are legitimately uncertain and you get comment letters and whatnot, and you might even have to do some restatement, I think the SEC is going to take a gentle hand, at least for this first year. That is what they've been saying for a while. So people don't need to hyperventilate into a paper bag just yet over the new rule. But second, to your point, Tom, about is this really a compliance process? I think it is, because yes, revenue recognition is a financial process. It is a financial issue. However, this standard really gets to how are you justifying the process of putting forth these numbers. It is about documentation. It is about documenting your judgment. It is about making sure the processes you use are full and complete and sound. And that is something compliance officers do, whether it is about anti-corruption, whether it is about SOX compliance, whether it is about data security. Who's the one who makes sure that people understand what the process is? The process is well thought out and correct and sturdy. That is the chief compliance officer. So that is why you should be definitely involved in what's going on here. At the very least, know what is happening so you can keep conversant in these conversations between the accounting department, the auditor, and the CFO. And you might wind up in a much more hands-on role than even that. But the bare minimum, you need to know what's going on.
You certainly do need to know that. Matt, this has been for me a fascinating exploration of this new revenue recognition standard. We've certainly taken it in ways that I hadn't thought through, and I hope our listeners have enjoyed this as much as I have working with you to put it together. So thanks for all the hard work and your thinking and writing about it.
Thank you, Tom.
Hello, everyone. This is Tom Fox again. I'd like to thank you for listening to this episode of our 5-part series on the new FASB revenue recognition standards. If you have any questions on this new standard of Matt and I, you can email me at tfox@tfoxlaw.com. You can email Matt at mkelly@radicalcompliance.com. Thank you again for listening to this concluding episode of our 5-part exploration of the new FASB revenue recognition standards. I hope you will join us again for our next regularly scheduled episode of Compliance Into the Weeds. Compliance Into the Weeds is a part of the Compliance Podcast Network.